Over the past few months, definitely since the change of government, there's been an increase in the amount of conversations my team and I have been having with clients about potential changes to the tax regime. Now, as anyone who's been in financial services for any amount of time will say, we will caveat the rest of this in the fact that you normally don't try and second guess tax reform, you don't try and second guess political change. However, this time does feel slightly different in some areas, and I'll just talk about that now. But the two main areas of discussion that we're having surround capital gains tax and tax-free lump sums or pension commencement lump sums from pensions, defined contribution pensions. And I'll talk about these in order. So if we think about capital gains tax first, capital gains tax has quite attractive rates in the UK as things stand. They've been chipping away at it by reducing the amount of capital gain you can make each year with no tax liability down. It used to be £12,500, it now runs at £3,000. And that does make a big effect because in the past, we could manage a client's capital gains tax withdrawals over the course of a year. It would allow for relatively significant amounts to be drawn out, depending on the portfolio in question. And it also gave scope for a good ability for us to manage portfolios throughout the year without triggering capital gains. Now, with £3,000 as an allowance, most portfolios are going to exceed that allowance with the natural portfolio turnover through the year, maximising opportunity and looking to protect on the downside through trades. And so therefore withdrawals from those portfolios will trigger whatever capital gains tax rate is liable. And there's two rates at the moment, and this is for investment portfolios. So residential property is taxed differently, but anybody whose gains plus their taxable income sits within around £50,000 pays tax at 10%, and then anybody whose gains plus taxable income sits above that pays tax at 20%. And that's quite attractive when you think about the relative income tax position, which sits at 20% and 40%. And so therefore, the question we're being asked is, if capital gains tax is to rise or change, should we be crystallising gains now? So if we just think about the first element, the most common discussion we're having is, will they align the capital gains tax rates with income tax, and thereby doubling the amount of tax that you may pay if you were to crystallise from the current regime to a potential new regime. Now, they could completely change the way CGT is taxed, but if we just focus on what we're talking about or what people are musing about at the moment, then should we crystallise those gains now? And whilst we would love there to be a simple answer, the answer is it depends. And without the holistic view of someone's entire financial picture and an understanding of how they may use those assets, it's impossible to answer. So this is not a yes or no. You won't be able to take yes or no from this discussion point. But in general terms, our clients look towards, or we advise our clients to spend their general investment account, the type of investment account that holds these gains first. The other two most common are pensions and ISAs. And for us, ISAs are dipped into and used as and when necessary, but they provide real flexibility of tax-free withdrawal. And that's a great thing to have longer term. And often you will use other different vehicles and then grab from your ISAs if need be. But the longer you can keep those tax-free environment, the better. And with pensions have the benefit of ISAs when they're growing in terms of them being tax-free, but they also sit outside of your estate, which currently sit outside of your estate, which ISAs don't. And so therefore anybody with inheritance tax liability, generally we hold off from taking from their pensions. So if we're going to spend from the general investment account, do we crystallise it now and use the current rates, or do we wait? And I would suggest that we are leaning towards crystallising now for a lot of clients, knowing their fuller picture. If you're going to hold assets, not necessarily trade them or trigger gains all the way until death, there's no capital gains tax then. So that's a different scenario. But if I was to have a scale, we are definitely leaning towards more a crystallisation at the moment for a lot of individuals, and then looking for other opportunities, other vehicles we can use, family investment companies, offshore bonds, smaller general investment accounts, because then your new investments will have a new base level, a new starting position, and gains above that will be taxed at whatever the future rates are. So that's capital gains tax. If we then look towards pension commencement lump sum or tax-free cash from pensions, what I would say here is this is much more nuanced, and there are a lot of implications of taking your tax-free cash out of your pension. In a pension, it's outside of your estate for inheritance tax, it's accessible and available to you, it's tax-free when you draw it, it grows tax-free. Great benefits, exceptional benefits really. When you bring that out, you brought it into your estate for inheritance tax, gains generated on allowable to capital gains tax, and income and dividends generated on the investments you hold are liable to income tax. So a much different position. However, the discussion is, what if tax-free cash is abolished? What if there are changes to tax-free cash? Now again, this is quite technical because we do think that this is something that the government may well look at, because it's actually a lot easier for them to look at it now than it has been in the past. In the past, there was something known as the lifetime allowance, the maximum amount that you could pay into a pension, which currently sits at just over $1 million and was higher previously. And when they brought this lifetime allowance down each time, they introduced protections which people could apply for. It's called a transitional protection, when a rule changes that allow you to protect what you've been given, what you've been promised. And that's an important fact, because it's likely, especially with pensions, that transitional protection or time would be available between the time that the change is announced and a point in the future. So we would expect that to be the case, because there's only really been, I think, one time in the past where they've changed tax pension legislation mid-tax year, and my understanding is that caused a real difficulty for pension trustees and administrators. So how could they now change tax-free cash? Well, because there's no longer a lifetime allowance, and because the maximum tax-free cash was 25% of the lifetime allowance, the maximum tax-free cash is now just a number, 268,000 approximately. And so it's now a lot easier to go, well, it's no longer 268, it's 250 or 225 or 200 or 150 or 100. Now, of all of these different numbers, the lower end seem quite extreme right now, and the higher end, feels like something they could be looking at and adjusting, but the likelihood is that you will have time to make decisions on this. Could they attack that? Yes. Do I think it's likely that they'll completely remove tax-free cash from pensions? No, but we don't have a hotline to Rachel Reeves. We're not involved in the conversations. And so the key thing with all of this is to consider your wider financial position, consider your long-term financial plan, and talk this through with your planner, who will understand the implications of making these decisions. These are the two main things that we're probably talking about. Inheritance tax is another one which we're going to do another update on. But anything like this, get in touch with your financial planner, get in touch with Becketts, and we'd love to talk it through with you. Thank you.